Hello, and welcome to this edition of the Mize Breakroom. My name is Marc Swearengin, Director of Business Development and Marcom here at Mize. Today, I'm joined with Brent Rill, shareholder here at Mize. And today, we're going to talk a little bit about tax planning. Brent, so welcome. Thank you for joining us today. Maybe start, Brent, a little bit about yourself and why are you here talking about tax planning?
I have been with Mize for over 20 years now, so kind of explored a lot of different areas in the company as I've kind of developed my own personal professional life and, started in accounting and even a little bit of payroll and really saw a big need in the tax department, which I think is very fortuitous for this discussion, in that there is a need for everybody to really be thinking about taxes and tax planning. It really is something very practical that we can do on an ongoing basis that really adds up. It saves money, from day one. The earlier you start doing some of this planning, the bigger impact it can also have and really add up over a lifetime or over your career.
I think that's great. You said something really interesting that I think a lot of people think of taxes and they think April, right? It's a fixed point in time. You just mentioned taxes and tax planning is ongoing. People should be thinking about it. It should be part of their thought process because the results happen once a year, but it should be something they're thinking about throughout the year.
Absolutely. And that's kind of my one hesitation that I have with clients is sometimes they're nervous to talk about us. One, they don't want to deal with taxes, which I totally get. But it is an ongoing thing as events are happening throughout the year. We really need to be having those discussions before the events happen, right? So we can do that proactive planning, structure the things the way they need to be to have the most advantageous output. So I absolutely am an advocate of having multiple conversations throughout the year, looking forward so we can see what's coming down the road and start planning for it.
How do you think about tax planning? And you just mentioned things about events and everything. So how do you think about tax planning if you're talking to a business owner? How do you kind of structure that?
Yeah, I always kind of put tax planning into two buckets, if you will, kind of the ongoing activity that might be a little bit repetitive, but it's the day-to-day, what's happening this year, where am I spending my money now? And then the other category that I kind of put into it is the life events. What are those big things that are going to change from year to year? They might become regular, like having a grandchild or some new family member. But that first event of when it first comes onto the scene really is the opportunity to think, how does that change my situation? How does that change the planning, the money that I'm spending? And that gives us the opportunity to kind of look at those bigger impacts. So again, those two buckets, I think, can become really important and two, separate conversations that we can have with clients.
I'm going to dive into each one of those individually. As we get into that, though, when people think it's taxes, tax deduction versus the tax credit, it's all part of that thing. So what's the difference? What's the difference between those two?
Yeah, I mean, both are going to save you money, right? A deduction is probably the lesser benefit, if you will, because that really is an expense that we are allowed to subtract from your income. So it will reduce your taxable income, but by the time you multiply that by a tax rate, it's really only saving you 30 cents on the dollar.
Oh.
So if you have, let's say, $10 of revenue and $1 of expense, we've reduced your taxable income down to $9. But once you multiply that by a 30% tax rate, you've really only saved that 30 cents. Versus a credit is a dollar for dollar reduction in that taxes. So it's something, again, that you've likely spent money on, but we can call that a reduction of tax. So in that same example where we may have had $10 of income, we now get to take that dollar straight off the tax bill. So It's just getting a bigger benefit, if you will, at that credit level versus a deduction. But both are beneficial. So I don't want to miss the opportunity for either of them.
Right. Do you feel like your business owners, do they kind of miss on some of that? Do they get that? Or where do you feel like you have to kind of educate most people, like people that are watching this, what kind of, where would you advise them to start?
Yeah, I think the deductions are fairly straightforward for people.
Mm-hmm.
Anytime you're spending money or bringing out the credit card, just kind of think, is this a business expense? Really,
Mm-hmm.
that's going to be our primary deductions for a business owner, because anything connected to the business should be a deductible expense.
Mm-hmm.
But, if you've got that commingled lifestyle, which a lot of small business owners do, we've got to think, is this a personal expense? Is this a business expense, or is it split? So there might be a little bit of determination that they need to go through to really understand if this is a deduction. And what I always kind of recommend for our clients is have two credit cards sitting in their pocket.
Mm-hmm.
So when it's business, they pull out the business credit card. When it's personal, they're going to pull out personal. The credit side, a lot of people don't necessarily think about
Mm-hmm.
those credits because it's specific areas that the IRS is kind of deemed as special areas that they really want to incentivize. So it's in the tax code itself where you've kind of got to know those specific areas to take advantage of it. So that's really where we can step in as tax professionals to kind of highlight those areas. And there are certain ones by, industry or by geographical area where those credits really become available. So the clients may not be aware of it. At the same token, I have had clients that might have a local credit come up in their city or their state. And it's so niche to just that small little area that they are the first ones to hear about it and bring it to our attention. A lot of those times we still have to do a little bit of the research to make sure you qualify for it, because really the government is trying to incentivize either a certain group of disadvantaged citizens or an industry that needs a little heads up to kind of mature and get to a profitable status. So there's some qualifications of, do you have the right number of employees? Are you in the right geographical area? So there's some complexity to it, but that's what we're here for, right? To help with
Yeah,
that.
it makes it sound like that's why you should be meeting with your tax professional, not just once a year, throughout the year, and having this, so you can have these discussions, right? Where you can talk more about these things that might be popping up and how to explore them. So that's good.
Yeah, and absolutely. As clients might be opening a new location, that's a huge undertaking for them to do, just for all of the logistics that go around it, whether it's a physical space, hiring new people, getting inventory, whatever you might be doing. But that is still the prime time to be looking at some of these other incentives. Are you building from the ground up? Are there going to be some credits to help you with that construction? But again, you've got to really get that application in before the construction starts for it to qualify. So again, just another point of being proactive. Maybe that discussion wouldn't result in anything. Maybe there's no credits available, but until you have the discussion, you just don't know. So again, being proactive is the key, right?
Yeah, just as a comment of something you said earlier, that was funny. I'm sure all the accountants would love your advice if if clients actually had the two credit cards. So when they're reconciling every month, it made it very easy for them.
I mean, that is the joy, right? We want to make life efficient for ourselves, as well as, stand up with the government. To me, that's the most important thing. To your point, making the accountant's life is so much easier, right? So a little self-serving for sure.
But I mean, but then you don't have those questions. And I think your first point is really something people should be thinking about. I hadn't thought about that point. Like, what can you do to reduce your risk? This is one of those things. The risk of an IRS kind of audit exists.
Yeah.
So how do you eliminate as much as you can? So that's really good advice.
Yeah, and I'm sure we'll get into it at some point. But everyone's heard the saying where you don't want the tax tail to wag the dog, right? So we don't want to go overboard with our tax strategies and planning and strategic activity. But two credit cards, it's not that difficult to really pull them out and use your business one, right?
Great. Yeah.
Even write a big old B on that business credit card just so it sticks out and you know which one's which. So
that's great.
Fairly easy.
Great. Let's dive into some of those areas you talked about. So we talked about, there's just the regular kind of year-end planning kind of thing. What are the types of things people should be concerned with? What are some ideas? What are, areas they should be focused on just the regular like year-end plan?
Yeah. So again, I consider Mize to be a small business accounting and tax firm. So really, our primary client is going to be a business owner, and that business is where our prime opportunity is. Are there reasons to defer some revenue, right? Most of the time, we're trying to save taxes. So how can we reduce that tax? And one of those might be deferred revenue.
Mm-hmm.
If your business has a situation where you can decide when you're going to work or decide when you're going to send your bills out for collections, you can time some of your revenue to some degree. Other businesses, when your customer comes in your door, that's a little bit out of your control, right? But that's certainly a big opportunity that we could be in control of. The other side of that is the deductions, right? And that's where the easier planning comes. You're in control of your own checkbook. When do you write those checks? So as we're getting towards year end, do we take that opportunity to buy some items that you've been needing? Whether it's a new piece of equipment for your business, whether it's some supplies that you might need, whether we're going to give year-end bonuses, make sure it's in the current year versus waiting till the next year so we can accelerate those deductions. All of that is going to help reduce your income and reduce your taxes.
Makes sense.
So when we look at that year-end planning, there's just a whole plethora of other things that we could certainly dig into. I don't know
like
how deep you want to get.
I would love to, like savings. People, like, depending on where they're at in their life, right? You might be retirement, you might be saving for education. So how do things like savings play into tax planning?
Yeah, and again, I think you've touched on it. Anytime you're putting money or spending money somewhere, let's just have that discussion to see if there's a deduction or a credit that we can generate. Because you've touched on two of the big ones, retirement savings and education savings. There are tax incentives, usually deductions, but sometimes credits for anything that you're doing in those two areas. So do you have young children that aren't in school yet, but you plan on them going to school? Should we start putting money into an education savings account? Most states offer a deduction for those contributions to those accounts. That account can grow tax-free until your child or family member or whomever you want to give that to goes to school, and then they start pulling it out tax-free. So the contribution you get a deduction for, and the account gets to earn money tax-free while it's in that account. And then when it's pulled out for education expenses, there is no tax on it. So it's really a win-win-win situation, in my opinion. The other one that you touched on is very common, of course. People need to be planning for their retirement. And the fact that we get some tax benefit for retirement contributions makes it a slam dunk, in my opinion. And it's going to be a similar concept where a lot of times we're going to get a deduction for the contribution. Those earnings are going to grow tax-free. And then depending on what kind of plan it is, it might even come out of that retirement account tax-free. So really, again, a win-win-win situation.
So as we're talking to your tax professional, like what are the best avenues if you're thinking about those things, like to take advantage? I assume there's options that they can be considering depending on maybe income levels or their station in life and all of that.
Yeah. And again, the IRS doesn't make anything easy on us, right? So the concept of retirement savings is great, and most people can take advantage of it. But what is the best vehicle, and what vehicles are allowed with your situation? Are you a W-2 earner? The answer is probably going to be different for you versus are you a small business owner? And then if you're a small business owner, do you have a lot of employees in your company? Or are you a one-stop shop and you're doing everything? The answers in all of those situations are going to be slightly different. The amounts you can contribute are going to be slightly different. So it is important to talk to, you could talk to a financial planner or a tax planner. Both of us really are going to be good resources, kind of determine what is the biggest bang that you can get for your buck. Because there are some really big numbers you can start putting away in some of those plans I mean, we're talking up to six figures in the right kind of plan. So it can make a
Wow.
huge difference.
How about things like charitable giving or things like how do people that want to, what is the impact? Should they do that? Should they not? How does that impact them from it?
Yeah, again, we really have a lot of great options when it comes to charitable giving. And some people are very charitably inclined and want to do
Mm-hmm.
a lot of it. Others want to do it occasionally. And there are vehicles to take advantage of both of them. Really, the big obstacle that we deal with right now is the large standard deduction. When we look at taxes, you really have two options when you're taking deductions on your individual return. You either go with a standard flat rate
Mm-hmm.
deduction. It's pretty high. It's close to 30,000 for a married couple. So a lot of people struggle to get over that threshold if they're going to use the other option, the itemized
Mm-hmm.
deductions. And your itemized deductions are a combination of medical expenses, uh, interest, mainly mortgage interest, state and local taxes, and then the charitable
Mm.
deductions that you've landed on. So for some people, it's important to time those charitable
Yeah.
deductions where they might double up in 1 year to get over that standard deduction threshold and then skip a year and then double up the next year, that kind of strategy to help get over that threshold. Another great option that a lot of business owners will take advantage of, especially if they have really a banner year or they're selling their business and have a big influx of cash, is what they call a donor advisor fund.
Hmm.
It allows you to put funds into this fund in year one, get the tax deduction in year one, but then you get to spread out when that goes to a charity over time.
Oh.
So it really allows you to build up that huge balance when you've got a large taxable income and can take advantage of a big deduction at the highest tax rate potentially, and then dole that out to charity over 10, 20,
Mm.
whatever years you might want. And in the same situation, that money is essentially in an investment account and can be earning interest and
Mm.
actually grow even bigger for the benefit of your
Man,
charities.
I love that actually. Just thinking through that, how important it is to sit down throughout the year, right? Talking about these things like, am I getting close to that standard deduction? Right? Not what other things could I be doing? Kind of leads me to a question about like, how should they be thinking about paying those?
Yeah, again, to me, some of these, like I would call these the ongoing planning activities.
Mm-hmm.
Really, we're going to develop a strategy and a consistent theme with clients that they like to give to charity or they want to save for retirement or multiple items,
Mm-hmm.
right? And we kind of establish what is the cadence of making those contributions to maximize it. When it comes to all of these deductions and credits that we've been talking about, there really isn't any difference on whether you do that on January 1 or December 31st.
Mm-hmm.
So the general strategy, though, is going to be let's go ahead and hold on to your money as long as
Great.
possible, make it towards the end of the year and
Okay.
take advantage of
Great.
that deduction. We do have to kind of coordinate with some third party, right? Because generally either a bank or an investment advisor or a charitable organization is going to have to receive those funds one way or another, right? So we might
Mm-hmm.
not want to wait until December
Right.
31st if they've got the office closed, but the
Right.
general
Right.
concept can apply.
Let's switch over to some of this, like the life events part of this, right? Because that's probably things where they're not thinking about it ongoing, and business owners that might be watching us, like there could be in various parts of their career. What are the types of things they should be thinking about with these events and the taxable implications?
Yeah, so we've kind of talked about a little bit. Anytime there really is a life event, so getting married, having a kid going to college, your children getting married, starting to think about your estate planning, that exit strategy that if you're a business owner, what does it look like to get out of your business? What does it look like once you switch from business income and expenses to a retired income and expenses? So really, any of those lifetime events really deserve some forethought. And I really put this category parallel to your estate planning.
Mm-hmm.
I know estate planning, a lot of people think that it really is only for super high wealth
Mm-hmm.
earners. But I would argue with that in that there are right ways to do estate and tax planning for every level of income. And it's really the people that don't do any of that planning that are at a disadvantage.
Mm-hmm.
I mean, even from the simple, modest income person, they need to have the right documents in place
Mm-hmm.
to make sure everything's going to be squared away and that they're not leaving a lot of open ends for their family members to deal with. So,
Yeah, I love what you just said. Estate planning doesn't mean that you're just the wealthy. I mean, it's about planning for your future. And I think people probably ignore that probably more often than they should be. Everyone should
yeah.
be thinking about this.
And again, like I said, I think estate planning and tax planning go hand in hand because as each one of these life events that I kind of gave some examples of, you should be reevaluating both pieces.
Mm-hmm.
As you have a new kid, do you have them in your estate plan? Are they in your will? Do you have power of attorney in case something happens to you? Who would care for your kids? And that just kind of goes on, right, for each one. So it's not a one and done on either the estate side or the tax planning side. It
Mm-hmm.
again needs to be a continual conversation and just revisit these events as they kind of happen throughout your
Yeah,
life.
because I can imagine you mentioned how much is the government going to keep that you want to give to give to your family or leave behind or keep for yourself through retirement. There's some big things like issues like I want to sell my business to my kids, like things like that. I would imagine have huge tax implications, like how to structure that.
Yeah, I mean, succession planning for family is a whole topic of its own. The IRS has a whole code section related to related party transactions. And unfortunately, they disadvantage related party transactions. They
Really?
really tax it at a higher rate, essentially. So there's a whole nother level of planning that really needs to go on when we are looking at succession planning and transitioning to subsequent generations within the same family. Definitely strategies to be utilized. But again, the importance of thinking about that and making sure you have a professional help you through it because it can make a big
Yeah.
difference.
Yeah, that's crazy. I did not know that. They
Yeah.
make it disadvantaged to kind of pass through what you've worked for.
Yeah, again, they're going to be looking at this of kind of a third party transaction. If you were dealing with just you and me entering
Mm,
into a transaction, I'm going to charge you full value, right?
right.
So they kind of have this expectation that everything's on the up and up. Versus if you're doing something for your son, Johnny, well, you're probably going to give him a break. You might not follow the letter of the law quite as close.
Mm-hmm.
So the IRS scrutinizes those
Mm-hmm.
transactions a whole lot closer.
That makes sense. How about some mistakes you see people make? What are some common mistakes people make, or obstacles they should avoid when they're thinking about taxes?
Yeah, again, I don't necessarily mean to toot our own horn, but honestly, the biggest mistake I see is high wealth individuals trying to do their own estate planning and taxes. I have under numerous accounts, and I won't mention any names because I don't want to get people too upset, seen some really intelligent people that are like amazing within their own industry run into a tax notice. So then I'll review their tax returns and find multiple areas that we could have helped about and saved significant dollars. And even at that point, I have amended returns because we're allowed to go back 3 years within the IRS statutes. I've amended those returns and gotten six-figure refunds for them because they've
Wow.
missed some deductions. So again, paying someone a couple $1,000s to prepare a return does hurt sometimes. But when you understand that they could be saving you hundreds of thousands of dollars, that couple of
Yeah,
$1,000s doesn't hurt so much once you realize.
feels like the risk reward is certainly there for folks, because I imagine getting a tax notice is not a very fun part of your getting.
Yeah, I think that's like the biggest fear, right? Maybe the IRS agent knocking on your door, or certainly people get apprehensive when they get that letter from the
Yeah.
IRS and don't know what it means. So I think, again, having that support of a professional, unfortunately, we've got many clients, so I've had to go through the process myself on their behalf
Mm-hmm.
because issues just come up. but I'm very comfortable with it. I've been through it. I know what to expect. I can kind of ease the client's expectations of this is the way it's going to go. We've got a good standing here. We're most likely going to get out of all this, but we need to step through the process. And this is how we do it. So I think that guidance certainly is reassuring. And again, I'm tooting my own horn here a little bit, but I think we're probably going to get better results because we know what to do. We know how the IRS is expecting to receive this information and what they want to hear. So we're most likely going to end up with a better result in the end for them too.
Well, that was a great way to kind of bring kind of closure to this. I think that's great with, if anybody has questions out there, obviously a wealth of knowledge here. You can reach out to us at the Breakroom at MizeCPAs.com. You can contact myself or Brent. We'd be happy to engage with you and ask any questions. I think it's an important topic that people need to focus on. We'll tell you, when I was getting ready for this, I'm like, oh man, we're going to do a tax discussion. And I think it's very enlightening. And I think something that everybody needs to do. So I appreciate your time today, Brent.
Yeah.
Let us know if we can help you.
Yeah, great. It was great talking to you. Thank you for sharing the couch with me. And it was great to catch up. Hopefully the topic wasn't too boring. I know taxes sometimes get a bad rap, but it is important to talk about. So hopefully this will kind of let people know that it doesn't have to be scary. We can talk about it and actually make some really good progress in helping to save some money.
You're right. Your tax professional is not a scary person.
Hopefully not.
Hopefully not. Thank you. All right.
Thanks, Mark.
Thanks.
All right.
Thanks for listening to another episode of the Mize Breakroom. If you watch this episode on YouTube, please like and subscribe so you never miss another episode. You can find the Mize Breakroom anywhere you can find podcasts. If you like what you heard, please rate and review the podcast 5 stars. Looking for more information? You can find us on most social media platforms at Mize CPAs. Thanks for listening and see you next time in the Breakroom. The Mize Breakroom is produced by Mize CPAs and hosted by Marc Swearengin. Mize CPAs is not a law firm and does not provide legal advice. The information shared in this podcast is for general information purposes only and is not intended to constitute legal or technical accounting, tax, consulting, and/or professional advice that may apply to your specific business. The listener is encouraged to consult counsel and/or their accountant before making decisions or taking any action concerning the matters in this communication to address the recipient's particular facts, circumstances, position, business considerations, or other unique relevant matters, as well as to evaluate any applicable federal, state, or local laws.